the repricing we've seen. We're now talking about an ECB that could go to 4%. A, do you think we get there? And if so, if we do get there, what does the market look like?
I think there's a real chance we could get there. In fact, we could go higher even to 4.25 or maybe even 5%. We have to remember, according to...
Sorry, you say 5%?
4.5.
All right.
Yeah, maybe 5, you never know. But, you know, the ECB on its own forecast has core inflation at 4.2 by the end of this year. So according to that metric, for policy rates should be above inflation, that would take us above 4.2. So I think that's quite possible. In terms of the impact, that should, in theory, slow down the economy. Part of it depends on how China does, because China is reopening, so there's a bit of a wild card there. But in general, this could have a reverberation across the European economy and cause quite a meaningful slowdown.
I've just been told I can actually ask a follow-up question, which I hadn't seen. There you are. This is going well. Where specifically would you look for the impact? I was mentioning BTPs a little bit earlier on. BTPs have been really well behaved thus far. The housing market in certain areas has not been. What is most mispriced for 4%?
That's a good question. I mean, housing for sure would be impacted. But the issue with housing, though, is that the leverage levels of banks, for example, just aren't the same as they were in the 2000s. So house prices could go down, but it won't have the same impact as we had during the global financial crisis. Instead, I think BTPs would be the obvious area. Part of the issue why BTPs haven't sold off as much is that inflation is quite high. So the debt to GDP of Italy is actually not looking so bad. But if we do start to see rates go up significantly, then Italy would be the vulnerable one here.
Okay, so if we do see ECB 4, even 4.5%, where does that leave then, say, the BOE and the Fed?
Well, starting with the Fed, I mean, we've had this long-held view that the Fed will end up raising rates to 8%, you know, which has been quite an outlandish forecast, but now looks, you know, plausible at the very least. So I think the Fed is on course to really surprise the market. You know, it may not be 8, maybe 7, but I think that's really going to sort of continue to move up. Bank of England's trickier, partly because the Bank of England has been so dovish, despite, you know, all the numbers that we're seeing within the UK. So I think the Bank of England is probably more in line with what the market's pricing. But equally, that could mean that the UK is perhaps more vulnerable to more persistent inflation going forward.
So what happens in all of these scenarios? So far this year, we've had a massive stock rally, bonds repriced as well. Now everybody's waking up to the reality you're talking about, and we are seeing equities coming under a little bit of pressure, bonds coming under more pressure. Is the rate repricing that we've had over the last sort of week or so enough? How much further could it go? Where do you, in terms of your kind of risk barometer right now, what is it saying?
Well, I mean, we do actually have a risk barometer, and right now it's actually not giving such a scary signal. It's basically saying there's moderate risk aversion. But I think what's helped markets so far has been that the growth data has been quite positive so far this year. And so we came into this year with lots of recession calls everywhere, and the data hasn't really panned out that way. So US payrolls has been strong, retail sales have been strong, PMIs across the world have been strong. There's some possibility of the China rebound. So the growth picture's really helped. But I think as time goes on, that will become less of a positive. So I would imagine in 3-4 months' time, the higher rates will really start to bite, and that's when you start to see the big asset sell-off across equities, credit, and so on.
Bilal, there is a school of thought that we've already repriced for that better data, and that the data has to surprise to the upside that much more now in order to really re-rate the terminal rate even higher. And you can make the same argument for, say, inflation over in Europe as well. It has to come in that much higher to really surprise. It doesn't sound like you buy that, though, that argument.
No, because, you know, at the moment, at least in terms of the terminal rate for the Fed and the ECB, the market is still pricing quite a benign outlook for inflation. So if you look at inflation markets from the interest rate fixed income, they're all pricing inflation to fall quite sharply in the next 12 to 24 months. And our view is that they won't. Inflation will stay higher for longer. And as a result, the Fed's terminal rate and the ECB's terminal rate will need to be higher. So there is still this implicit assumption in markets that inflation will naturally just come down. And I think that's the big mispricing at the moment.
Our question of the day yesterday was sell everything, buy the dollar. Is that a good trade right now?
I think on balance, in the short term, that would be a good trade, but I don't think necessarily that's the best trade right now. I think instead the best trade is to be short rates right now, to play for higher yields in general. The challenge with just being long dollar against everything is that other central banks are also hiking as well. So in January, it was the ECB repricing that led to the euro going up. Then this past month, it's the Fed repricing. Then next month, it will be another central bank repricing.
It's a spiral.
It's a spiral. But underlying all of this is yields yields going up everywhere. So that's the common factor here.
This is the dumb question, Bilal, but like how high? Like what rate goes the highest? Is it going to be the 10-year repricing above 4? Is it going to be over in BTPs? Like where's going to be that big mover?
I think the biggest mover will probably be more at the front end of the curve, like the 2-year. So the part of the curve that's more linked to policy rates. The long end, the 10-year, will naturally be sort of pulled down the higher central bank rates go, because that will naturally be recessionary. So you have this kind of recession versus inflation dynamic further out the curve. But in the front end, it's more inflation more than anything else. So I think its front end yields will go up a lot more, which then means the curve will invert much more deeply than we've seen since the early 1980s.
Just coming back to the dollar trade, though. As you say, we could see rates biting maybe midway through this year. Asset prices get battered as a result of that. In that scenario, where are you hiding? What is the asset of choice? Because normally that's the point at which you kind of run home to the dollar.
Mm-hmm.
I think in that environment, you're right. I think the dollar would then, in that environment, do very well, because in that environment, the euro, EM markets will all sell off quite aggressively. So that's probably the sweet spot for the dollar, and we probably will see that later on this year. The path to that point is a bit trickier. The other one possibly could be the Japanese yen as well, as a risk aversion trade, because the BOJ is a bit more active now, so there could be some bias or flows into Japan as well. But for sure, the dollar would be the currency of choice.
Okay, at some point the dollar, maybe the yen, you're shorting rates. What are the top moves you guys are making right now?
So, yeah, short rates and flattening trades as well. We also, tactically, in the short term, we're actually quite bullish on the pound. I mean, generally, we're very bearish on the UK, but, I've recently been speaking to lots of investors around the world, and everyone's so bearish on the UK that just from an anti-consensus perspective, I thought it was good to be long the UK. And the data's been relatively, surprised to the upside somewhat, and also the Brexit news at the margin, I think, helps markets as well. So I think in the short term, pound, I think, will do better, probably against the euro, more so than against the dollar. And then in equities, I'd probably have a bias to be bearish on equities at the moment, because I do think we've had a nice run up in data generally, and I think that would likely start to roll over soon.
Let me ask you the question I always ask you. Cash. You've been incredibly positive on cash. Is there the option of just sitting this one out still?
Yeah, I mean, if I had to pick anything, I'd still pick cash, because, cash, you're getting nice yields now, 4 to 5%, depending which country you're in. Plus, you preserve your capital. And I think, we're still in this environment where rates haven't quite broken markets yet, and they will at some point.
Bilal, it's always great to catch up. Thank you very much indeed for stopping by to see us. Bilal Hafeez, the CEO of Macro Hive. Coming up, we're going to focus on the banks. Santander shares having a great day today. In fact, the whole of the banking sector is having a great day today. A 3-year high for that stock, though. This after this company has unveiled its latest